Hello viewers, welcome to my session on accounting principles. Previously I posted a video for accounting concepts, basic accounting theoretical concepts, and in this video we are going to discuss on the accounting principles. The accounting concepts and conventions together make the accounting principles. Now, what are accounting principles? They are the rules and guidelines that companies and other bodies have to follow when reporting financial data. Or otherwise, in short form, we can say that the standardized terms and methods that accountants must use while recording the financial data refers to accounting principles. So at the time of journalizing the transactions and posting them into ledger and in the preparation of the final accounts, the accountant has to follow certain standardized guidelines that are called as accounting principles. Now, what is the short form for, what is the meaning for IFRS and GAAP? IFRS is the abbreviation for the International Financial Reporting Standards, which is the most widely used set of accounting principles which are adopted by 168 nations. In India, we follow IFRS guidelines, and GAAP is the abbreviation for generally accepted accounting principles. Now, this is an exclusive set of guidelines or rules for the citizens of United States of America. Here in India, we follow IFRS. In US, they follow GAAP. Now, IASB stands for the abbreviation of the International Accounting Standards Board, which issues the International Financial Reporting Standards. In the United States, it is the Financial Accounting Standards Board, FASB, that issues the generally accepted accounting principles called as GAAP. Now, what is the purpose of accounting principles? The ultimate aim of any set of accounting principle is to ensure that a company's financial statements are complete, consistent, and comparable. When we say complete, it has to give the full information, and there should be consistency followed in the practice of accounting methods. And comparability is the flexibility in comparing the financial statements between two periods or within a company, between two departments, or the income statement of this year with the previous year, or between branches. Now, the accounting principles refers to the accounting concepts and conventions, as I said earlier. Now, what are accounting concepts? The accounting concepts define the assumption on the basis of which the financial statements of a business entity are prepared. Now, there are few concepts like business entity concept, money measurement concept, going concern concept, accounting period concept, accounting cost concept, dual aspect concept, matching concept, realization concept, and accrual concept. Now, the first concept, business entity concept, says that for accounting purposes, the business enterprise and its owner, the promoters of the business, are two different independent entities. There is no connection between the owner of the business and the business enterprise. Thus, the business and the personal transactions of its owners are separate. That is why in journal entry, we are making a separate entry under drawings account for any of the assets or cash or materials taken by the proprietor or the owner from the business. So that is to distinguish between the personal property of the owner and the property of the business. It is treated separate as drawings account debtor to cash if cash is withdrawn by the owner, and same way drawings account debtor to goods if the goods are taken by the owner, and drawings account debtor to any fixed asset if the owner is taking any asset from the company. Now the second concept is money measurement concept. This concept states that every transaction or any transaction which could be measured in terms of money are only entered in the financial records. The two in terms of the currency of the respective country where the entries are being made. So in India, we are measuring in terms of Indian rupees, and those which can be quantified in monetary terms are finding place in the record. What will happen to the qualitative terms? For example, an employee who is loyal and very sincere. Yes, but there is no place for this loyalty and sincerity in the books of accounts. Only quantitative terms are entered that can be measured in terms of money. Now the third concept is going concern concept. This concept states that the business firms will continue to carry on its activities for an indefinite period. Simply stated, it means that every business entity has continuity of life. Thus, it will not be dissolved in the near future. It is expected that the business will continue for a longer period, say 30-50 years. Now, the next concept is accounting period concept. This concept states that the transactions are recorded in the books of accounts on the assumption that profits on these transactions are to be ascertained for a specific period. Normally, the accounting period is for a period of 12 months starting from 1st of April ending the 31st March of the next year. Say for example, for this accounting year, 1st of April 2024 to 31st March of 2025. So the concept requires that the balance sheet and the profit and loss account should be prepared at regular intervals. And as far as a joint stock company is concerned, it is mandatory that they have to publish a certified audited balance sheet. So in that way, it is necessary for different purposes like calculation of profit, ascertainment of the exact financial position, tax computation, etc. Now the next concept is called as accounting cost concept. This states that assets are recorded in the books of accounts either their purchase price, which includes cost of acquisition, transportation and installation. Together all the three are called as purchase price, and it is not at its market price. Financial assets will, any long-term assets will not be entered on the market price, but it is for the actual incurred cost of purchase price is being entered. It means that the fixed assets like building, plant, machinery, furniture, etc. are recorded in the books of accounts at a price that is actually paid for. The next concept is dual aspect concept. This concept assumes that every business transaction is having two effects. That is, there are dual aspect like debit and credit, which affects two accounts in their respective opposite sides. Therefore, for a single transaction, both the debit and credit aspects are recorded in the books of accounts. This duality concept is commonly expressed in terms of a fundamental accounting equation. Assets is equal to liabilities plus capital. So in the balance sheet, we have two sides as assets and liabilities. On the liability side, we have also capital. So the condition for the balance sheet is that it should have the same equal total on both the sides, which means that the accounting is get tallied. So the assets is equal to liabilities plus capital is the fundamental equation which is expressed based on the dual aspect concept. Now the next concept is matching concept. This states that the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. So all the revenues are matched with the expenses which are pertaining to the particular accounting year, and whether received or not, it has been taken into account. In the same way, all costs incurred, whether paid or not paid during the year, should be taken into account while ascertaining the actual profit or loss for that year. Now the next concept is realization concept. This concept states that revenue from any business transaction should be included in the accounting records only when it is realized. The term realization means the creation of legal right to receive money. For example, selling goods is realization, but receiving an order does not simply mean that it will give revenue. So only when the goods are supplied, when goods are delivered to the customers and the payment is received from the customer as cash, then on realization that's being recorded. This is what we mean by realization concept. The next is accrual concept. This is the last concept, which says that something that becomes due, especially an amount of money that is yet to be paid or received at the end of accounting period. It means that the revenue are recognized when they become receivable, whether it is paid or not. Same way, the expenses are recognized when they become payable, whether it is paid or not. So that is why we have prepaid expenses and received income in advance will be accounted in the assets and liabilities side based on the nature of the income and expenses. So once the revenues are recognized, which means that it becomes receivable whether we received or not. Same way for the expenses. So both the transactions will be recorded in the accounting period to which they relate to. Now next we are moving on to the conventions. Now what are accounting conventions? An accounting convention is the unwritten laws or otherwise called as doctrine, which refers to the common practices which are universally followed while recording the transactions or presenting the accounting information of the business entity. Now in short, we can describe conventions as the customary practices or the traditions that are usually followed since from long. Now, there are four accounting conventions: convention of consistency, convention of full disclosure, convention of materiality, and convention of conservatism. The first is convention of consistency. This convention states that accounting principles should be used for preparing financial transactions should be same every year. There should be consistency maintained by the company when they are recording the financial transaction. Uniform method of accounting is to be followed continuously for years together so that helps the company to go for meaningful conclusion as well as comparison between the accounting records over a period of time is permitted because of the consistency in the practice of accounting followed. Now, the second convention is convention of full disclosure. This states that all material and relevant facts concerning the financial statement should be fully disclosed. The company should not conceal or mislead with any false statements. Full disclosure means that there should be full, fair, and adequate disclosure. Adequate means the sufficient set of information. Fair indicates the equitable treatment of users, and full refers to the complete information that is presented for the general public or to the stakeholders of the business. Now, the third convention is convention of materiality. Any information that is provided in the financial statements should be meaningful and it should be like the material facts only to be given. Important and relevant information should be supplied to the users of accounting information. Now, the last convention is convention of conservatism. This convention is based on the principle that the business concern should also expect possible losses. There should not be only anticipation for profit. Though profit is the ultimate aim of the business, they should also provide for possible losses. It provides guidance for recording transactions in the books of accounts. And it is based on the policy of playing safe in regard to showing profit. So the company should not overstate profits because there is always a danger that the the shareholders will ask for more dividend if the profit is overstated. So the company should be careful when they are giving the profits, and only when the profits are realized they should state in the records. And with that, we are coming to the end of this session. Thank you for watching. I will be posting materials on trading account and profit and loss account and sums under trading and profit and loss account in the later videos. Thank you once again.